Hello traders out there in Traderland, D7 here at Grok Trade, and this is the weekend edition video, good through Sunday, March 8th, 2020. It's Saturday morning and I'm having my coffee. So, and I should edit that out, but I didn't. I'm letting you guys listen to me cough. Here, markets, bearish territory, but bouncing back up after a really bearish, bloody Friday. One that really concerns me is financials down 3.3. Everybody else doing better than that, but still down nearly 2% on major indices. That's a bloodbath, guys. Just relatively speaking, not so bad, right? Crude oil, and just down a whopping 9%. We've been bearish on crude oil, and it continues to dive. Silver down, gold slightly higher. VIX had a massive spike, and it came back down, but we'll look at that here. Bitcoin at 9,100, so it is heading higher. All right, here we are looking at the markets. Subscribe and all that good stuff. Any coffee fans out there? And by the way, I'm becoming a coffee snob, and if you have an opinion on the best coffee. Now, I don't like to do a lot of stuff. I'll grind my beans. That's about it. Some of you guys have AeroPresses and French presses and all that. I need something simple. I want the best beans out there. That's relatively for good value. I don't like dropping $1 million for my coffee. So if you have any tips, leave them down in the comments below. Here we are looking at the spiders. So here's the deal. We had this big drop on the S&P 500. Big drop. We bounce, we go up to, and I have my fibs drawn in here. Do you see the 50% Fibonacci? We get up right here to the 50% Fibonacci and then dropped on Thursday. When that happened, let me get rid of that line. When that happened, that was a great place to short. That's called a bear pullback. You can go to freeonlinetradingeducation.com, freeonlinetradingeducation.com, world's longest URL. You can do that and look for bear pullback in the chart school. And that is a great setup for a bear pullback. Now, something very interesting happened on Friday. We dropped, which we should have done, right? We should have dropped. But then we bought into the strength, just like we bought into the strength here, and then we rallied higher. They bought into the daily strength here. Okay, I'm going to get rid of the fibs just so we can look at this a little cleaner. That's the 200-day moving average coming across. Because of this, that tells me that we might have an opportunity to go higher going into this week. If that happens, you'll have a W. Do you see that? Down, up, down, and then up. That's a W, or a double bottom. W stands for winner. Wow, wonderful. It stands for all sorts of great things. So if that happens, this could be a bottom and we could start going higher. But we have a lot of upside resistance, such as the falling moving averages, such as all these major trend lines. So a ton of upside turbulent or areas that we could hit our head and fight the bulls big time. But we dropped. Can we come back? Especially now that the coronavirus, people are starting to thumb their nose at it. Like here in Indiana, that's where I reside. We had our first case. They sent him home and to do his to quarantine himself. It's Saturday morning. Give me a break. Saturday morning. Quarantine himself for 14 days. I had a fever, sniffles, colds. It's just, mild state of the flu is what it seemed like. So people I think we're blowing it out of proportion. However, you should be short the stocks, the cruising stocks, and maybe even the airline stocks, at least for short term. But those will give us great buy opportunities soon enough. Okay. So that could happen. We could bounce here. If I look at the diamonds, same thing. We drop, bear pullback. There's the short opportunity. Friday, we made money, but then we came up, filled the gap. and we did it on strength. Let me show you something. See the volume that we're seeing here at this area that we might be getting a trend reversal pattern? Same thing on the spiders. We go back here, look at the volume. Huge, huge volume. This is the average 20-day line coming across here. That's the average. And this is 2 to 3 times average, okay? So this could be capitulation that we're seeing. So a change, meaning this is a bottom and we should start heading higher. I'm not saying that's going to happen, but it's building a great case for this. NASDAQ, what's just fascinating to me, and you've got to watch this. Remember, we've talked about this in the last couple of videos, and if you haven't watched the last 2 videos, make sure you go and do that. It'll be highly educational. Go specifically to the Qs, QQQ. And when we hit this with the red candlestick, I said, mark my words, man, if we break below this, we are done. Next day, we went below but rallied up and closed above it. You see that? We closed above it, and then we rallied up. If I go to a line chart, you'll see how we went down and bounced right off of it. See that? That's really, really interesting. Very interesting. The candlestick start, Friday, we gapped down below those trend lines again. But guess what? We came back up closing above it. That's telling me that smart money, they are honoring these lines. And that's what you have here, specialist behavior. Technically, this is the NASDAQ. These are market makers. But anyway, I'm getting technical. You'll learn that stuff in mentoring. But we're building a decent chance of a rally happening coming into this week. I mean, I see it. Now, I'm going to throw a wrench into that here in a second, okay? But if you look here at the Russell's 2000, again, bought the weakness. We did make a lower low here. But here are the financials. The financials did the worst. They're dropping drastically. But here's what's very interesting to me on the financials. This is XLF. This is the biggest financial index, 500 major banks strong in this index. So it gives me a great understanding of what's happening in the financial world. Big drop on Friday. But look how this line that we've had in here forever, and let me give you the points of this line. This line goes all the way back to February 10th, 2016. 2016. This is a daily chart we're looking at here. 2016. And then it goes to December 24th, 2018. So those are our 2 points. And you can see the node. This was the last place I drew it because I always go past it a little bit. There it is. And then here in 2020, sure enough, we get down there. Buyers, we get near that area of support, and buyers like, that's a great area to buy. I love doing that. We get near a big level of support. I like to buy in at that level and with a lot of upside opportunity. So that is interesting. But I want to go to the weekly chart on the financials to see what that's showing me. So if I go to that weekly chart, we're at major support again. So we hit it back here, 2016, February 2016. We touched it June 2016. We bounced right off of it December 2018, and we're right at it February 2020. Well, technically we're in March. That's where we're at right now. So this dude has a really good chance of going higher. Now, let me tell you the part that I don't like here, okay? So you're going to hear me talking out of both sides of my mouth. Even though we're at major support, the trajectory of this drop to the downside makes it that much harder for this to remain as support. The faster it drops, the more it breaks support levels. This was a nasty little drop, but we did bounce, fortunately. We did bounce there. This one was not a nasty drop. We did drop, and then we started rolling over, and then we get a hammer. No problem. The ones that kind of just softly land, I'm okay with those. This is a different ball game. This is a huge bowling ball made out of lead that just fell onto support. Will the floor hold? That's the big question. I'm watching financials big time because financials, whatever they do, the rest of the market follows, period. So that's important to me. That's what I'm watching really, really closely. So just mark my words that we had this discussion, okay? Just like we did on the Qs last time, we're watching the financials this time. We're watching the financials. So again, I'm going to the daily charts. If you look here at the US dollar, it broke a major trend line. US dollar is in a lot of trouble. A lot of trouble. We knew it was going to when it rallied up. It failed to hit the area of resistance. See this? We got there, we got there, we got there. We did not get there. It's relative weakness. We drop and then we broke support. Broke support. And that support goes back to the charts I'm using are Trading View. There's a link down below. Trading View. I love them. And one of the cheapest platforms you can get your hands on. I like great value. Remember me talking about coffee? I want good value. Value. But anyway, check this out. This is March 2018, April 2018, and then right here, December 2019, and we broke it right here. We broke it. Makes you want to look at the weekly on US dollar. Oh, and the weekly broke a major support line also. So the US dollar is trash, short the US dollar. That is in a lot of trouble. That will help the stocks, help commodities, help everything. But as far as the US dollar is concerned itself, it's weakening big time. Crude oil took a nasty spill. If you look here at the daily, bear pullback, we talked about a good short opportunity, drops, bear pullback, good shorting opportunity, big drop, big volume. Crude oil is bad. But we talked about this. When it broke support, this is when you go, anytime you break that support line, that is go time. That's go city, man. That is bearish city. Let me show you. If I go to the weekly chart, on the crude oil, last week we broke it. I said, man, that is in a lot of trouble. And look what it did this week. And there's more downside opportunity here. A lot of downside opportunity. Ouch. Ouch. Silver. Silver is very interesting because shot up, gave us a death hook. We dropped, but we rallied up, okay? We rallied up. Friday should have been the short. That's a perfect area to short silver, but they bought into the strength. It went down, and then they bought into it. This could be a fake opportunity to go short. I'm watching these trend lines. Will we get back above them? Maybe. In other words, you don't have the trend lines, that's fine. Watch the moving averages. Does silver get back above those? I mean, I really need to see us get above 1675 on SLV. Really need to see that. Gold had a great time. Thursday it broke out. It's staying above it on Friday. Gold is rock solid, liking it. A lot of turbulence. You see how we went outside the trend lines here? A lot of turbulence there. VIX got up to the high of 54.4. 54! You know what? When was the last time we got there? So let's go back in time. Let's shrink this. Whoa. Holy smokes. This one only got to 53. And that was in 2015. August 2015. That was August 21st, 2015. The last time we had that high. Wow. Was January 2009. Wow. Last time we were there. To put that in perspective, guys, that was the financial crash. So let me show you something. Before that, the last time we hit it, okay, let me put this into perspective. Do you see how we went up? Right now we got to 54 4.5 with the shadow. This shadow did the same thing. It actually went higher. It actually went to 58.2. This is what happened right after. It went to 57, 63, went to 70. This is the fear indicator. These are unbelievable numbers, okay? We drop a little bit, we drop, then we jump back up to 69. We got up past 80. We just could not believe these numbers. These were historical numbers. Drop around, and then we popped up, got up. Man, I remember this. A high of 96.4. 96.4. Knocking at the door of 100 on the VIX. This was the financial crash, guys. This is 2008. And I was calling my videos 2007 saying, warning, 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 watch out. This stuff is looking bad. 2008, we fell out of bed. Look how the norm is staying above 50. Fear is above 50, between 50 and 80. That is just unbelievable times. Unbelievable times. I lived through the technology drop when the technology bubble popped in 2000. I traded in 98. I started trading. I had to learn to navigate those waters, those turbulent waters. I had to survive, right? I'm treading water. I'm staying afloat. I had to navigate those waters. But that hardship, learning to trade in that environment, made me a stronger trader for sure. I saw the 2008 crash happening before it happened just because I was highly in tune with the technicals at that time. So that was very helpful. Anytime you can learn to trade in turbulent times and survive. Most people don't survive. Most people don't have the bank accounts to survive, and they just don't. So if you double click the side here in the bottom, it brings you right back to where you're at. That's where we're at. So this is where we're heading higher. This looks indicative to the other major crash. We are due for a significant pullback in the markets. This pullback, guys, could be nasty. I'm sorry, it's Saturday morning and I still, I'm coughing and stuff. I don't have coronavirus or COVID-19, I promise. But I want to build up a case here, and I want you guys to listen to me, if you're still with me. This run up looks a lot like what we saw in 2008, where we got to these levels and we're heading higher, and it just kind of the floodgates open up and they kind of go. It looks very similar to this, but there's underlying issues that I think are fundamentally different. And here's the deal. Technically, if I was only looking at the technicals and throwing out the economics of it, I would say we need to be setting up to go big time bearish right now. Big time bearish. Here's the reality. I'm going to show you this in a monthly chart on the spider. Okay. Now, I think this will be very, very interesting to you guys. Very, very interesting. Let me get rid of my Fibonacci's. Every candlestick you see here is 1 month. 1 month of the S&P 500. What I want to do is bring in a lot of data. This data, I have mine going back to 93. 1993 is where my data starts, okay? 93 to 95, and you can see the dates down here. 93 to 95, something amazing happened in technology at this point. What happened in technology was the internet was born. It was born earlier, but the masses become mainstream in 95, going into 96. Matter of fact, I started a company called AutoIndiana.com, AutoIllinois.com. I own those domains now. They're dormant at this moment, but I had those before Amazon was Amazon.com, Google before Google.com. I was out way before YouTube. I had my companies before any of those. Matter of fact, interesting information, I started my trading videos in 2004. That was before YouTube. That started, I think, in 2005 or 6. I started my trading videos. They got popular in the UK. Over in Europe, they blew up over there at Trade to Win thing. You can go and find me under DES44, DES44. You have to really look back at those videos. But those videos were in 2004. Nobody was doing trading videos on a regular basis like I was. Nobody was doing that yet. I was the first. I was the pioneer to do that. 2004, before YouTube. Think about that. And our website went #1 on Google. I don't think we're #1 anymore, but we were top dogs there for a while. We just don't market and stuff, as you know. Anyway, check this out. We go higher here. Technology bubble pops. Now, what was interesting here for you guys who love fundamentals, I do. I like to pick my companies fundamentally. That's what we teach. We pick our companies fundamentally, and then we trade them technically. You have the best of both camps. That's the best way of trading. Well, at this time, we were seeing something very interesting where all the people that had a .com and had a domain that were anything technical, people and VCs, venture capitalists, hedge funds, big money, smart money was shoveling dollars into anything technical. And they were inflating the prices that didn't make sense anymore. They were way overvalued. And one thing I like to look at is the PEG ratio. It's the PE, price to earnings over growth, usually a 5-year outlook. But I look at the PEG ratio, and when I saw the inflated PEG ratios, because there's this big argument that started taking place, hey, we can't justify or validate putting money into these tech stocks anymore. They're way overvalued. And a lot of people say, no, they're not. We just keep going up, keep putting money in. We were beating our chests. We were saying, no, you cannot keep putting money into this. You're going to get burnt. And sure enough, the technology bubble dropped. Now, let's look at this drop real quick. Oh, wow, I didn't know we'd be doing all this, but I'm going to do a Fibonacci retracement on this, okay? So let's go down to these lows. Go up to these highs, okay? So what I did was I went down the low, extended it to the highs, and I would just want to see how much of a drop it did. Went up, down, down, down. 61. It lost about 65% of where it come from. Do you guys see that? That's a 61% retracement at this line, but this line would be, if that's 75, we're talking 65, 66%. I'm guessing. Before it started going higher. Now, I want you to pay attention to something. This from 95 goes to 2000. 95 to 2000 is 5 years. Then we drop 3 years. We go from 2000 to 2003. There's our W for winter, wonderful, wild. Remember that earlier? We were talking about that W? That W was when we loaded back up. You're back in 2003. We go higher, 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 higher. We come to these highs. Do you see this? We come across to these highs. This is 2007. That's M for murder. Do you see this? If I do this, up, down, that's an M. Anytime you get an M at the top of a run, that's M for murder. Bad things happen. And we were saying, watch out. This could be dangerous. Watch my videos back here. This could be dangerous. Sure enough, this happened. That drop happened. And now this is December 20, January 2008. And that was the beginning of this crash, right? So this had a nasty little drop. What's interesting there is if I go back from the same lines here, okay, go here and then go to this one. you could almost argue we're at 76% drop. We gave back 76% of where we came from, okay? From this area. Gave back 76. Think about this. It was actually more, right? So it was like 78, 79, almost 80, perhaps. I don't know. That's a nasty pullback. This was 65. This was 76. Okay, those are the pullbacks. But these are healthy pullbacks that happened after 5 years. So this was 2003 to 2008. 2003, 2008 is 5 years. So we ran up 5 years, 3-year pullback. We ran up 5 years to 2008, and then we had a nasty little pullback. And we bounced here in 2009. So this was like a 2-year pullback, right? So instead of a 3-year pullback, this is a 2-year pullback. It was a much deeper, more aggressive drop to the downside. And now we're going to go higher. Okay, so let's get rid of this. So now we know to be looking for a 5-year run. So we're starting our run in 2009. Okay, 2009, we go higher, higher, higher. So 2009, 5 years, puts us at 2014. So let's go to 2014 area. This is 2014, right here. This is our 5-year run. 5-year run, technology bubble popped, dropped. 5-year run, financial problems, and we drop. 5-year run. And I'm going to get to my fundamental difference between where we're at now and where we were before. I know I'm taking a long way around it, but I think this is educational for you. We should be dropping here. Now we go up. Now we're 2015. We're 6 years long in the tooth. 6 years. And there we start to drop. Do you guys see this? Let me blow this up a little bit. See the drop here? Drop, drop, drop. Now we're dropping after 6 years. We should get a nice pullback. Our pullback could be 65%, could be 78%. Remember that? We talked about it. Could be that. We pull back more, we pull back more, and then it's almost like we're not ready to drop. And we go higher. We go higher. Now we're in 2016. We're 7 years. 7 years in here. We get to 2018 and we start to drop. Okay, this was very interesting. We're 2018. We're 7 years, right? In here. 2018. So again, we start right here. 09. And now we are at 18. Yeah. Oh, 7 years. What am I talking about? 7. We're so. Yeah. So yeah, 9 years. So think about this. We go up higher. We drop. We're 18. So we start back here, 2009. We are 9 years into this run without a significant pullback. We get a little bit of pullback here. November, the fall of 2018 was bearish. We had some times. Then we run up higher. And now, this is where we're at right now. This is where we're at. We have this drop, but we continue in this run. We are now 2020. We are 11 years long in the tooth before a significant drop. Now, the question isn't if we're going to drop, it's when, right? Because the markets always go up and they always go down. And we need good reasons on when we do what, when. So this is interesting. If I do a Fibonacci here to this low, go up to this high, to put this into perspective, if we drop from this low, and these lows, again, were 2009. 2009. It's a long time ago, 11 years ago. We could, if we drop just what the technology bubble did on the pullback, we're going to be at levels that we saw in 2013, 2012, 2013. That's if we drop just like the technology bubble. If the financial bubble, we're going to drop down to where we were in 2009, back 2010, 2011. So all the money that we've made, all these profits for long-term holds, you'll give it all back once we pull back. Now, what we look for in trading is a nice bull pullback to the 38% or the 50%. I'm telling you guys right now, if we've only dropped here a short amount, 10% or so. This 10% is freaking everyone out. Times that by 5 and get down here to the 50%. That's a healthy pullback to an area of support. That would be a great area to pull back to and to buy, to load up and rally yet again. That would be a great area. But it will feel like there's blood in the streets. It will feel brutal. You guys will think that the earth is coming to an end with that sort of drop, because think about it. We're not going up 5 years and pulling back 3 now like we were in the past. We're up 11. So if you go up 5 and you pull back 2 or 3, okay, then what we should see here, if we're up 10 or 11, you should pull back 4 years, maybe 5. Are you with me? You guys see my logic there? If our normal bull run is up 5 and you pull back 2 or 3, okay, so we'll just say half. It pulls back half on average. It's actually been worse than half, but we'll just say half. If that's the case, we're up 11 or, 10 or 11 right now. We're up 11. If that's the case, we should drop. The next drop we have that's significant will last 5 to 6 years. 5 to 6 years, not 2 years or 3 years like we've seen in the past. But it should, relatively speaking, be 4 to 5 to maybe even 6 years down. I'm speaking technically there, just based off of market behavior, past performance, which is never indicative to future performance, okay, or results in any way, shape, or form. I'm saying what is the norm could play out that way. In other words, we go up 11, we pull back 5 to 6 years. 5 to 6 years. So right now we're in 2020. So that would be, that'd be bad. Now, who says we're going to pull back now? Nobody. Nobody says we're going to pull back right now. We could keep going higher. This is what I think. I think the markets, for its own reasons, believe that the Trump administration is good for the economy as a whole. And we're seeing good indicators of that. And I think that's why the markets, we keep finding these excuses to drop, but we keep going higher. I think it's because we don't have any underlying issues that is that the mainstream considers bad enough to crash this market. Now, what will it take to get this to crash? If the coronavirus isn't crashing the markets, I mean, it's turbulent right now, but and it can keep going. Okay, this could be the excuse that the markets need to finally let the markets drift down, which is very natural. It's a natural ebb and flow. It's natural for that to happen. Very natural. So this might be the good excuse for that to happen. If we start dropping more, the algorithms, the smart money who have their AI, artificial intelligent bots that are trading, will trigger sells at certain levels. Sell, and that's where you get the stock market that will shut down the market because the selling was too aggressive, and they'll just shut it down, which I've experienced several times now. One story I should tell you. It was at that time the biggest single day I've ever made money in the market. It's made over $25,000 in a matter of an hour, $25,000 in my pocket, and they took it away from me. Oh, I'm still ate up over that. That was the micro crash we had in May back in 2013, I think. Or anyway, I can't remember what year it was. So But here's what I think is interesting. Could an election change up things to cause the markets to finally drop, to have its healthy pullback? Maybe they could do that. But we don't know until it happens. What I do know is we have a significant little pullback right now, but the coronavirus, just mark my words, it's going to be a moot issue going into the future. Okay, this is just unfounded fear. I mean, people are dying, but you got to put it in perspective. But I mean, SARS was far worse. The bird flu, far worse. Ebola, MERS, and all sorts of. They come and go. Now, this one will do the same. I think the election, if President Trump loses, it could be an excuse going lower. We know that the market keeps going higher with him but a war could trigger it, any sort of war. He doesn't seem to be too hawkish as an individual. But let me tell you what the big elephant in the room is. And you guys are already probably saying this to yourself. It's our growing deficit. That's where our administration is screwing up. Our deficit is out of control. Our debt is out of control. What's the difference from debt and deficit? Deficit is how much you're spending. That's your budget that you're spending. Your debt is how much you owe. We owe over $22 trillion. Knocking at the door 23 last time I looked. That is unbelievable. That is a debt that we can't get our head wrapped around. We will have to answer to that at some point. And what is fascinating to me is, why are we not talking about the debt and deficit in the debates, in the political debates? Why is our political leaders, why is our president, who is a staunch businessman, saying we got to get rid of debt, let's get our costs down? Why is that not happening? Why do we keep going higher? I think we're going to pay the price. We will ultimately pay the price for that. If the U.S. dollar, if our government outside of the U.S., okay, other international governments, especially Asia, China, specifically China, they're already thumbing their nose at our currency as being the world reserve. They want the one to be that. And right now we're making great headway. I'm glad that we have a change of course that we're taking with China right now. We have I think this administration is fixing that problem to some degree, and that's helped a lot to balance, because their economy was going to beat our economy. It was going to be the number one economy. It was on that trajectory. We have changed that. That is good for U.S. and U.S. stocks. But soon as the U.S. dollar, when people don't have confidence in that anymore, if people don't have confidence in that, we are in dire trouble. So I think that's the elephant in the room. I think that's what we all should be talking about. And it's interesting that we're not. And I don't know why. So I'd love your discussions. Please leave them down below. If you made it this long, say, hey, I made it. Fascinating. Hey, I made it. You bored me to death. Hey, fascinating. I'm confused. Hey, fascinating. I think you don't know what you're talking about. But let's hear your thoughts on the economy, where we're heading, what's going on, and where we're at. If this is the first time you've been with us, hey, welcome. Small ecosystem. If you don't know, we have a class coming up February or March 21st. What you do, go to Grok Trade, click on Trading Mentor up here on the top, this Trading Mentor line. And when you scroll down, if we're giving away 1 full year of our stock picks, these are my stock picks on the bull and bear side, and they're fundamentally screened and technically reviewed. It's usually $300 a year, or $30 a month. That's what it usually is. I'm giving it away free for people who qualify. You can see terms down here, but if you qualify and you have a call with us about our mentoring, ideally this, but we have another one coming up in April. But there's the date. So if you'd like to join us, that's what you do. So I hope this was helpful. Take care, guys, and we'll catch up with you later. Bye.